All right, we have more changes unfolding in the U.S. economy and over at a major U.S. bank. Changes that have the Fed's tighter monetary policy clearly taking its toll as the second largest regional bank in the country, a bank known to be exceptionally strong and one of the best run institutions in the banking industry. Well, even they are now feeling some pain as the era of easy money is over. We're now in the decade of higher inflation and yields, which means substantially lower profits for banks. So much lower, in fact, that even PNC Bank, a bank that was supposed to be solid, one of the best run banks in the country, well, even they are suffering the consequences, the jawboning by the Fed. So we'll look at what just happened to PNC, how they're trying to get ahead of this, where the flow of money has been moving that's putting them in such a vulnerable position, because there's a reason that this is happening. It's the reason why the Fed's been so careful lately, chose not to hike the overnight rate these past few meetings. It's because there's something that they're waiting to see, something that all of us will see in just 2 more weeks. But before we get started, press the like button and subscribe. It's totally free to do. It's just a click of the mouse, helps me out, and I appreciate your support. So the FOMC, the Federal Open Market Committee, a group of Fed presidents and governors who get together 8 times per year behind closed doors and decide the future of all of our economic policy. Well, we have 2 more weeks, folks, before the next meeting, and since their last 2 meetings were just duds, holding rates steady at 5.5%, many market observers are speculating that they'll raise rates again after the bonanza of new jobs created last month, 336,000 new jobs created in September. At least that's according to the government, the BLS, the Bureau of Labor Statistics. But even if we take their number at face value, it's small potatoes in the bigger picture as the most important number, the most important report that these FOMC voting members are waiting to see, report that we'll see in 2 weeks as well, isn't the jobs data. The jobs data is important too, but what's even more important, what the Fed sees as critical before making any decision to change the overnight rate again, is seeing the results of SLOOS, the Senior Loan Officer Opinion Survey. Hands down the most important report in this current econ cycle, the report that allows them to get a glimpse of what's coming as it lets us watch the banks, the institutions who actually create new money, as that's how our system works, right? Money is created when banks write new loans. And for the past 26 months, banks have been less and less willing to do so. Like you see on this chart, the higher this line goes, the more banks have tightened lending standards, made it more difficult to obtain financing. The average is around 15%. The red shaded areas are recessionary periods. What do you notice each time that this happens? Every time this line breaks 60, a recession follows shortly thereafter. Back in 1990, lenders stopped lending. Boom, recession. Again during 2000, banks make it tighter and tighter. We hit 60 and boom, the dot-com bubble pops and we enter recession. During the run-up to the great financial crisis, what was happening? Banks were tightening loan standards while the Fed was raising rates, and boom, recession. Saw the same thing a few years ago and again today. Right now, we are on our way to deflating this everything bubble that we're currently living in if banks stay on course like they've been since July 2021, 26 straight months of credit retraction. This is what the Fed's watching, what they are waiting for, why they need to be so cautious right now, and why they waited to hike the last few meetings. You hear people say all the time, why does the Fed not just raise rates already? Why pause? If they're going to do it, then just do it already, right? Well, this is the reason. Hiking again before knowing just how much banks have tightened up shop could be a huge mistake. This process, limiting credit availability in a system that relies on credit for just about everything, is just as effective, if not more effective, a tool as rate hikes are. And the Fed knows it. Also, this chart that we're looking at is just for business loans, by the way. How difficult banks have made it for small businesses to obtain financing. Well, what about CRE, commercial real estate? Even tighter, folks. Well over 60 now, at 71% tighter. Virtually as difficult today to get a loan for CRE as it was during the worst days of the great financial crisis. And we all know what's happened to CRE this past year. Real estate investors unable to refi their properties, which the vast majority have to do every few years. Commercial real estate loans have floating rates, adjustable mortgages, very different debt structures than most residential. And there is a wall of these floating rate loan maturities barreling down right now, ramping up significantly in 2024, increasing each year for the next 5 years. 2023 was just like a prelude, folks. And guess who holds the paper on the bulk of these loans? Small regional banks, regionals like PNC Bank. Now, it should go without saying that PNC's far and away a stronger business than almost all other regionals, which is why when I saw the news, I really couldn't believe it. Realized 6 months ago, PNC was bidding. They were vying to acquire First Republic after it failed. It was them and JP Morgan who were competing to buy the company, buying all their debt, being considered by the FDIC when all that went down. Here's what the Wall Street Journal said at the time. Big banks, including JP Morgan Chase and PNC Financial, submitted offers for the troubled lender earlier Sunday. So what the hell happened between then to now? Well, we'll get to that in a minute. First, take a look at what Reuters reported on Friday, saying PNC Financial reports drop in profit, begins job cuts. PNC Financial Services Group said on Friday it's cutting about 4% of its workforce and reported a drop in third quarter profit as a surge in funding costs offset higher interest from its assets. Also reporting weak results on loan syndication and merger and acquisition revenue. Well, good thing they didn't merge and acquire First Republic, because even a bank like PNC is clearly feeling the pain of the Fed's jawboning. I'll show you in a minute what's really behind this, though, what's really happening to them. And by the way, if it's happening to them, you know the other regional banks are doing just as bad, probably much worse. Here's what Bloomberg reports. PNC says 4% workforce reduction will save $325 million in 2024. PNC Financial said it started reducing headcount by 4% as the bank navigates fallout from higher interest rates that have eaten away at profitability. Look, PNC is known as one of the best run banks in the country. Great management team over there, which could be why we're seeing them do this before any of the others. This may be good management at work, good stewardship of the company, something that the other regional banks are just putting off, putting down the road, kicking the can down the road. Here's what they write. Personnel expenses will fall $325 million in 2024 as a result of the cuts, which began on October 6th. The Pittsburgh-based lender said it in an earnings presentation Friday, but the move will result in a one-time charge of $150 million during the fourth quarter of this year. That's normal. The company had 61,000 employees as of December 31st. CEO Bill Demchak said during a financial services conference last month that the bank would provide an update on a more structural program that would affect 2024 expenses. Now listen to this. They write, PNC, which avoided many of the issues that led to the collapse of several regional lenders earlier this year, hasn't just stayed on the sidelines throughout the turmoil. The bank joined a coalition of lenders that injected billions of deposits into First Republic Bank to try to keep it stable before they collapsed. This month, it bought $16.6 billion portfolio of capital commitment facilities arranged by failed Signature Bank. Writing this, a so-called super regional, PNC is the second largest U.S. regional bank with $554 billion in assets as of June 30th. So what's really happening here? Well, their net interest income, the most important metric for any bank, has gotten eaten away. Here's what Reuters says. The bank also forecasts its net interest income, the difference between what banks earn on loans and pay out on deposits, to drop 1% to 2% from current levels in the fourth quarter. Its third quarter NII, net interest income, also fell 3% on a sequential basis. That's a lot, by the way, folks. Banks work with like the smallest of margins. Now, does this have anything to do with them buying part of Signature Bank's loan book a few weeks ago? I doubt it. What this has to do with is the Federal Reserve's QT, quantitative tightening, all but forcing banks to write less and less loans, depriving them of their core business. Loans are like a bank's bread and butter, right? The fewer loans they write, the less they can earn. And coupled with the record level of cash inflows the past 10 weeks, it's forcing all banks to get their house in order, clean shop. As liquidity dries up, we can see what's happening on this chart. As money market funds continue bubbling up, right? People are putting their money into cash, turning into the next like big bubble, $1 trillion inflow year to date, and even more, 1.4 trillion if you look at bonds as well. Account holders at PNC Bank and all other banks, moving their deposits out of their bank accounts and into money markets and treasuries, hunkering down in cash as bond yields offer like these substantial returns, equity-like returns. Money markets now offer around 5.5% sometimes. And if you look at slightly higher risk bonds, for example, a 25% blended equal weighted investment, for instance, like 25% of 30-year treasuries, 25% of investment grade triple Bs, 25% high yield triple Cs, and 25% emerging market high yields would give you over 9%, like 9.3% or something like that. It's a new world, folks, a high inflation, high yield world, which means real assets are the likely winners for the time being. Real assets always seem to do better in this type of environment. And what I'd say about PNC, well, it's a good thing that they lost the bid to buy First Republic. I'm sure they'll, be fine in the long run, but it shows us that even the strongest of these regional banks is not immune to this level of tightening. All right, if you enjoyed this video, got something out of it, press the like button. If you didn't, that's all right too. Either way, I appreciate you watching.